Three separate storms are converging over your financial life right now, and the one institution that normally rides to the rescue can't even move. A $3.5 trillion private credit market is closing its gates. The U.S. economy just printed a 0.7% GDP growth for the fourth quarter, and Brent crude is above $104 because U.S. forces struck Iran's Kharg island on Friday night. When these three storms converge, your portfolio is right in the crosshairs. Let me start with the storm that's been building the longest and the one that most investors still don't completely understand, and that's private credit. This is the $3.5 trillion market that the financial industry spent pretty much the last decade building and selling as the new safe harbor. Patient capital, they called it. Illiquid by design, generating premium returns because investors were willing to lock up their money for years at a time. Middle market companies that couldn't access the bond markets, loan structures with covenants, yields that made traditional fixed income look pretty sleepy. The pitch was simple. Give us your money, be patient, and collect the spread. That story is coming apart, unfortunately, in real time right now. Here's what happened last week specifically. Morgan Stanley's North Haven Private Income Fund received redemption requests for nearly 11% of its shares. Investors, they wanted out. The fund paid back 5%. For every dollar investors tried to withdraw, they received roughly only 45 cents or so. Blue Owl went even further and permanently shut the doors on its OBDC2 fund, not gated, shut. BlackRock's HPS lending fund received more than $1 billion in withdrawal requests and paid back only about half. Cliffwater capped redemptions at 7% after investors tried to pull out a record 14% from the fund. And then JP Morgan did something quiet that should really have been front page news. JP Morgan, the largest bank in the United States, quietly marked down the collateral that private credit firms use to borrow against, specifically loans to software companies. Think about that for a second. Think about what that means. Private credit firms don't just hold loans. They use those loans as collateral to borrow more money, which they use to make more loans. That is hardcore leverage. When your collateral gets marked down, your borrowing capacity shrinks. When your borrowing capacity shrinks, you sell assets to cover the gap. When you sell into a stressed market, those sales set new pricing benchmarks. Those benchmarks get applied to every similar loan on every other fund's books. It is a feedback loop, and JP Morgan just lit the match. If you like this type of content, please click like and consider subscribing. It's really important to be in the know, and this is exactly how you do it. Now, weather pattern number 2. Friday morning, the Bureau of Economic Analysis released the second estimate for fourth quarter 2025 GDP. The number was 0.7%, not 7%, not even 1%, 0.7% annualized real growth for the final 3 months of last year. The advanced estimate had been a disappointing 1.4%, and the revision cut a disappointing number in half. Consumer spending was revised down. Exports were also revised down. Government spending fell partly due to the October shutdown, which the BE estimated knocked off roughly 1 full percentage point off fourth quarter growth. But here's the combination that should scare you a little bit. The same day that GDP came in at 0.7%, the January PCE report showed core inflation running at 3.1% year over year. Slow growth, rising prices. You know, there's a word for that, right? It used to be used in only polite conversation since 1970s, and that word is stagflation. You're going to be reading it everywhere this week, I can promise you that. And those numbers are backward looking. That was Q4 of last year, before the war in Iran, before the oil spike. The data is already stale, and it's already bad. Weather pattern number 3 showed up over the weekend with literal explosions. U.S. forces struck 90 military targets on Iran's Kharg island Friday night. Kharg island accounts for roughly 90% of Iran's crude oil exports. Central Command said oil infrastructure was spared. Then the president said that the U.S. might hit it again, quote, just for fun. Iran's Revolutionary Guard responded with missile and drone strikes on 3 U.S. bases and Israeli targets, calling it only the first round of retaliation. Brent crude opened this morning above $104 per barrel. WTI briefly traded above $100. The Strait of Hormuz, my friends, through which roughly 1/5 of the world's oil supply passes, remains effectively close to commercial traffic. For an economy that just printed 0.7% GDP growth, an oil supply shock is the last thing you want arriving at your doorstep. And the Federal Reserve meets this Tuesday and Wednesday with no real good options on the table. Cut rates to help a slowing economy, and you pour fuel on an inflation fire that's already burning at 3.1% core PCE, while oil above $100 threatens to push the headline number even higher. Hold rates steady, and you watch a 0.7 GDP economy continue to suffocate under high borrowing costs. The Fed is pretty much stuck. Here's where the math becomes actually a little terrifying. Private credit firms lend to middle market companies. These are businesses that are too small for the bond market, too complex for traditional banks. Those companies need functioning economy to service their debt. When GDP is running below 1%, revenue growth slows. When oil spikes, guess what? Input costs rise. When the Fed can't cut, refinancing becomes even more expensive. Stressed borrowers inside those private credit funds, the ones paying interest through PIK toggles and creative restructurings rather than cash, are now being squeezed from every single direction. Simultaneously, the fund managers who were quietly hoping to work those problem credits out over time just lost the two things that they needed most. That is time and a cooperative economic backdrop. The impatient investors watching oil surge and GDP collapse are all reaching the same conclusion at the same time, and that is, get me out. The redemption wave accelerates. The forced sales also accelerate. The pricing benchmarks drop, and the feedback loop does not slow down. It intensifies. Any one of these three weather patterns, private credit stress, stagflation, or an oil war, would be debilitating, but manageable on its own. The market has dealt with each of those in isolation before, but each of those previous episodes came with a Federal Reserve that had room to maneuver. That option right now is effectively gone. Banks are already pulling back. JP Morgan just told us so. And the investors who funded that $3.5 trillion private credit market are lined up at the gates that are already essentially closed. Here's how I want to leave you. Superstorms aren't permanent. They're violent and they are very disruptive and they cause real damage, but they pass. The sky does eventually clear. And when it does, the investors who stayed calm, who understood what was happening and actually prepared their portfolios accordingly, those are the ones who find bargains in the wreckage. The greatest buying opportunities in market history have never come when the weather was perfect. They've come when everyone else was running for cover. Now, this is not a call to panic and sell everything. This is a call to understand the forecast, batten down the hatches, and make sure you're standing when this all clears. Because when it does, and it will, you want to be positioned to move. So your truth bomb for today is this. When private credit is gating, GDP is printing 0.7%, and oil is above $100 because we just bombed Iran, the Fed cannot ride to the rescue. And that changes everything about what comes next.